Assalamu alaikum wa rahmatullahi wa barakatuh. We will start, inshallah, the session. Any of the sisters would like to attend? Any of the sisters? We have a room downstairs, inshallah, where you can come. We have the, brother, if you can just talk a little bit. Inshallah, so whoever wanna enjoy. Okay, no problem.
This will be better. Okay. Jazakallah khair. All right. That's fine. We'll just, I don't want to take up too much of people's time, so we'll manage with the mic. Like I mentioned, I'm from New Jersey. I'm visiting here. We have a team. We just hired a local representative named Hood Williams, who was gracious enough to set this up for all of you. He wasn't available tonight, so I'm here since I'm in town for a couple days. A little about me. I was born and raised in New Jersey. I worked with Wachovia Bank when I got out of college for a few years. Now it's Wells Fargo. After that, I joined JP Morgan Chase. I was a branch manager there. Then I moved over to the investment side, the wealth management group. So I managed affluent clients throughout the New York City area. Did that for a few years, so total of 11 years with them. And then Saturna was, or Amana mutual funds were, and I was using them with my Muslim clients, so they approached me and asked me if I wanted to come on board. So eventually, after a few years, I decided to join them. So I've been here since October of 2018, so a little over 3 years. But I have over 18 years of managing people's money and investments. So that's a little about me, and so let's get into the presentation. So today I just want to highlight some important points. Hopefully this will be very useful for you. So why do people invest? So here's some of the reasons why people save their money, right? They'll either save it in a bank account or they'll save it and invest it into another investment account, right? So these are some of the reasons here. Buying a home, Hajj, children's education, retirement, and health savings. So we're going to talk a little about that. And so what are some of the goals of investing? Why do people invest? Obviously, I mentioned there's some reasons why we're investing, but the main, these are three main reasons. You want to preserve your capital. What does that mean? That means having your money keep up with inflation, right? Nowadays, you're looking at a very interesting time where the cost of everything has gone up, right? You want to buy a house, it's not the same price it was a year ago. You want to buy a car, good luck even trying to find a car, right? So those are things, preservation of capital, you want to keep up with inflation. Capital growth. Capital growth is you're trying to also grow the money, right? Not just stay at 2-3%, which is just at inflation. You're trying to beat inflation and increase your money that way, okay? Another popular reason why we invest is income. You want some kind of income. Whether it's in retirement, whether it's, something to pay your bills, something you want to put your money away and also get some income from that, and that will help you in the future. So those are the three reasons, or three goals of investing. Okay, these are some habits of successful investors. Okay, what do? They invest for the long term. They save early, meaning they start as early as possible. They don't delay it, because the longer you delay it, it's going to be a little more difficult to catch up on, depending on what your goal is. So if your goal is retirement, best to start early as possible, right? Diversify. Diversify means, you heard the term, don't put all your eggs in one basket. Put into different things, right? So you may hear about people investing into this stock or that stock or this Bitcoin or some other cryptocurrency or real estate. That's a very popular one as well, right? The other one is don't try to time the market. There's a lot of people that think they're smart. Even the people who have worked in the industry like myself don't try to time the markets. I just leave it and let it go. You try to keep it as a long-term goal. So I'll give you an example. Coronavirus happened, right? Last year started. What happened to the market around March of last year? It started going down. So people got worried, they freaked out, emotional bias kicked in, and some folks might have sold their investments thinking that, okay, I don't want to lose everything, okay? But then 2 months later, everything starts going back up. In fact, it went back up so much that it ends up having a strong year at the end of the year. And so by that time, you're thinking, oh, I should put my money back in now. Or no, I'm going to wait till it goes down even more. But that time never comes, so it just continues to go back up. So what is the moral of that story? Just leave it alone and let the markets do what it has to do. So don't try to time the market. Appreciate the impact of fees and costs. Of course, any investment you look at will have some kind of cost inside, internally or externally. So you should, consider those costs as well and understand emotional biases, which I covered before. And then volatility. Markets are going to go up and down, right? So you got to understand that. That's how markets grow, and that's natural. Distinguish between good companies and good investments. Okay, you want to make sure you're investing into healthy companies that are doing good for the environment. As a Muslim, this is very important, and we'll get into that. Understand the value is driven by cash flow. So whatever's coming in, that's going to help the balance sheet, and that's going to make the company grow. In turn, as a stockholder or a shareholder, your investments will appreciate. Take advantage of 401k plans, and we'll talk about that. Okay, so one of the topics or goals is investing for college. How many of you are in college or have a child that's going to college? Anybody? Okay, so tell me about college tuition costs these days as compared to maybe 10 years ago. Right, so here's some statistics. Public college costs rose an average of 1.6% beyond inflation, right? So we're talking about around 4%, something like that, from 2010 to 2020. These are published tuition rates. Again, this is just an average, 10,000 to more than 37,000 a year. And you're kind of right in that ballpark, right? You mentioned around 40,000. So it's not going down is the point I'm trying to make here. Since 1990, the average of private school has more than doubled, and the average public tuition has nearly tripled. So that's something concerning if those of you who are trying to go to college or save for somebody going to college, how are you going to pay for that? So that should always, be on your mind. And then this talks about debt. Now, you finish college, your child finishes colleges and gets out and they have a bunch of debt. How are they going to pay it? They get their first job, they're living paycheck to paycheck. So again, this is another issue, debt. So we need to solve this issue as well, right? So one of the things you can do to help save for college is do a 529 plan. The only issue with, and I'm going to address it, it's the last bullet point, is it has very few halal choices. So if you're looking to do a 529 plan, you should really pay attention to what the underlying investments are. So like a 401k, they give you a menu of investment options, right? You could pick from this fund, that fund, that fund, that fund. Now, the issue becomes that some of these funds may have some haram in them, like some companies might be, alcohol or tobacco, something like that, right? And so those are things we need to look out for. But we mentioned the 529 because some folks may already have it, and the thing is that some people may already go into that. So we just bring that up, okay? But the advantage of this is you save for the college, and when you take the money out for college, it comes out tax-free. It goes to the university directly, and you could only do up to $15,000. You could save up to $15,000 per year per child. So if you start early enough, right, and you put some money away, you'll have a substantial amount saved up. So let's move on from that. So what is an alternative? If you don't want to do a 529 plan and you're concerned that you're going to be investing into something that's not, permissible, you could do an ESA plan. It's called the Education Savings Plan. This can be used for, your primary education and higher education. That means is you could use it for like an Islamic school, you could use it for undergrad, you could use it for graduate school if you're doing a master's or something. The only limiting factor here is it's $2,000 per year per child. It's not like $15,000 like it was with the 529 plan. The other issue with this is they have, so if your income is more than 190,000 for joint filers, or between 190 and 220, you cannot contribute to this plan. So if you're making income below that, then you can do it. Now, if you're single, this mentions joint, right? Now, if you're single, that limit is 140,000 as an individual. So if you're making more than 140,000, you cannot contribute. But what this gives you is the flexibility to invest into whatever you like, whether it's a halal mutual fund or it's a real estate, like a REIT or something. You can choose that within that account. So that's one way to do it. The other way is, how many of you opened a bank account for your children or had a bank account when you were a child, like your parents opened it, right? Those are called UGMA accounts, UGMA, Uniform Gift to Minors Act, or UTMA, Unified Trust to Minors Act. So these are the two kinds of accounts. And if you go to a bank and you open an account for your child, they will open this kind of account for you. And you're allowed to put in $15,000 per year per child, okay? The only thing with this is it doesn't come out tax-free for college or for any reason. But for the parent, this is advantageous because it gets taxed at the child's rate. It doesn't get taxed at the adult rate, right? Which could be like 30%, 40%. It will be taxed at the child's rate. It's called a kiddie tax. So that's usually, it could be 10% or less, or it could be 0. Depends on the situation, okay? And this, you have the flexibility to also put into any investment you like, whether it's the Amana mutual funds or whatever other halal funds you have. You can put it into this type of account, and it allows you to save for the child. And the one thing about this is when they turn age of majority, it becomes their property. So you have no control over it. So I remember when my father had a Charles Schwab account for me when I was young and I turned 21, Charles Schwab kept calling me, you need to come in to sign some paperwork. I said, what is this about? It's because your father opened this account and now it's your property, so you need to make this account yours and take it out of his custodianship. So that's what happens, and I don't know what the legal age is here. It could be 18, 19, 21, depending on which state you're in. Yeah, you could do it for the grandchild, up to $15,000 a year. Yeah, you can do that, sure. Excuse me one second. Sorry, I'm having some technical difficulties. What I'll do is I'll take some Q&A. I might have to reboot this laptop. Just cancel it. Anyone have any questions on anything we've discussed so far? Or any other general questions, I'll take them. Yes? Okay, good question. So what is the difference between Amana mutual funds and the 401k? So I want you to picture, let's picture like three different cars, right? Like, let's picture a shell of a car, right? The Amana mutual fund, so let's call the first car 401k. The second car, this Atma account, okay, that we just talked about. Let's say the third account is an IRA. You've probably heard of that too, right? These are all empty shells. What you put into the cars, the engine, is the Amana mutual fund. That's going to drive the 401k. Or if you put whatever other investment, let's say it's Apple stock, you put that in the second car, that's going to drive it. So what Amana is, it's a mutual fund, and we'll get into that. A mutual fund is a group of stocks that have been screened. They're Sharia compliant. So let me try this again. So yeah, so 401k, and just to explain a 401k, that's set up by your employer. A company sets that up. That's a benefit that's given to you being an employee of the company. So for those of you, yes? Yes. It's not taxable. When you roll over from your 401k to an IRA, there's no taxes. The only time you have a tax is when you do a distribution. So if you make a withdrawal and you say, I want a check for this amount, and then it goes into your bank account, that's the only time it's going to be a distribution. It's going to be taxed. No, you're not stuck with the money. So here's the thing. If you're under 59 and a half, you can't really touch it. There's a penalty if you do. If you're over 59 and a half, you could take the money at any time. You're not stuck with it. You will pay taxes on it, on the gains, right? Or actually, no, you're going to be taxed on everything. Because if you're in a 401k, it was pre-tax. So imagine you got paid, right? You look at your paycheck, and you'll notice a bunch of deductions, taxes, and then you'll see 401k contribution. That contribution went into your 401k account pre-tax. It was never taxed. So when it does come out, when you do take it out, you will pay taxes on it, assuming you're over 59 and a half. Does that answer your question? That it depends on your tax bracket. It will depend on where you are in life and your tax bracket. So it could be for me it will probably be like 35% for you, since you're older. Or it depends on your income. The best person to ask is a CPA, your accountant, who works on your taxes. Or if you look at your last tax return, it will tell you your taxable rate. So that's probably the best way to. All right, we're almost up and running again. Sorry, I had to reboot this laptop. It got stuck on the slide. Technology's never perfect. So we don't predict the markets. Having expectations is, if I had that crystal ball, I probably wouldn't be here on a Saturday night talking to you. So, yeah. So when I say preservation of capital, okay, that means that you're putting your money in a vehicle. It could be an IRA, it could be a regular account, it could be whatever. But as the money grows, you're preserving what you've put in, right? I mean, of course, there's a risk to it, but the more risk, the more reward. However, that money is going to grow over time, okay? So if I have a client that says, hey, brother, I have some money. I want to invest this money for 5 months because I want to buy a piece of property and I'm looking for a house. I normally wouldn't advise them to invest the money. I would say, you know what, just keep it in a safe place like a bank account or under your mattress, wherever you keep your money, and don't risk it. Because why do I say that? Is because let's say in a few months the market takes a downturn and you need the money then because you worked with your realtor here and you found a house and you need that money and the value has gone down. So that 50,000 you saved up is worth 46,000, let's say, just because of the timing of the market. But now let's say that same money you gave it 3 years, and alhamdulillah, with time it grew, right? It grew to, let's say, 60,000. So that's why it all depends on an individual situation. But there are instruments, halal instruments, that we will talk about that you could preserve your capital without taking too much risk. So we have 4 funds, and I'm going to get into that. But the other important thing is retirement. And I might skip some slides just for the interest of time. I don't want to keep you guys too long. So some of the questions you need to ask: how long do you have till retirement? Do you have 3 years, 5 years, 7 years, or more, right? What are you planning on doing? Are you planning on staying or moving? Hopefully staying, because everyone in Jersey left to come to Dallas, so they already took care of that. They ended up moving. And your lifestyle, what kind of lifestyle do you want to live? Do you want to travel? Do you want to take vacations? What do you want to do in your retirement? Do you have enough to do this? Okay? And who's coordinating this? You, your spouse? Do you have an advisor? It's very important you have these conversations because as we've learned through COVID and more recently, people are, passing away unexpectedly. We don't know. Nothing is guaranteed. It's written. Only Allah subhanahu wa ta'ala knows when we're going to end up passing away. So we need to prepare for this, for our families, for our children, for our spouses. So will I have enough money? Okay. So regardless of whatever you're saving, the common question I'll get as a financial planner is, I need to know if I'll have enough money in retirement. What is that going to look like for me? Which accounts am I going to take that from? So 37% admit they have no idea how much money they'll need in retirement. So that's very concerning because the best way to plan is plan ahead, and if you don't know what you're planning for, then I would suggest getting with a financial advisor or a planner and discussing this. Okay, how are you going to fund it? Is it going to be your checking account? Is it going to be your savings account? Is it going to be the pension plan, the Social Security? Or are you going to work through retirement to help pay for your costs? Okay, so these are some vehicles. Brother mentioned 401k. That's the first one, right? I kind of went into that. IRAs is another retirement account. It stands for Individual Retirement Account. And HSAs, Health Savings Account. These are accounts that you can control. For the most part, you can control where your investment goes into. You'll see annuities, bonds, and CDs. They're in brown. We highlight those and we list them because these are instruments that unfortunately they're not permissible because they're interest-based, right? So annuities, if it's a fixed annuity, is paying like an interest similar to a CD. You put your money in for like a year, 5 years, and they pay you a fixed interest rate. So that's why it's not permissible. Same thing with bonds. Bonds produce interest. So that's why those are highlighted. But the ones in the white you can invest into: mutual funds, real estate, the life insurance, the cash values. These are acceptable. So pension plans, not every company offers this, but let's say you're blessed with a good job and part of your retirement package or your compensation package is they put money away in a pension for you, okay? So when you retire, you have a stream of income coming from that. That's like a bonus, okay? You could do a lump sum distribution as well, meaning you take all the money at once and then you put it and invest it wherever you want. And then retirees need to create their own retirement income, okay? So beyond this, you need to work out a different plan because this alone won't sustain you in retirement. The average check, Social Security, is $15.55, it says, in 2021. How much is rent here? What's the average rent for like a 2-bedroom? 2,000? Okay. That doesn't even cover rent. And let's forget about your, your expenses of eating and, going out to the movies or taking a vacation. So the point I'm trying to make here is you need to do something beyond this, right? You can't just rely on Social Security. You can't rely on your pension fund. Yes, brother. Oh, this one. They're not permissible, no. They're permissible, certain ones are permissible, like amount of mutual funds. And we're going to get into why it's permissible. Just hang on. Yes? Correct. No, you can. So what I mentioned was you have the ability to control your investments, right? So you don't have to put into bonds. You could just have an all equity portfolio. But we're also going to get a little deeper than that, right? So give me a second. I'll take some more questions once I just wrap up this part. And if you want to learn about your Social Security benefits, you can go to ssa.gov. Sometimes in the mail, they'll mail you a statement that says what the expected check would be once you retire. So let's move on. So here are some statistics. 79% intend to continue working, 29% worked after retiring, and 48% retired earlier than they planned. That's really the goal, right? For most of us, we want to try to retire as early as possible. Okay, and then I'm going to get into compounding. So how do investments work? How does a mutual fund work, right? This is an example. At the bottom, it starts at age 25 and it goes up to 65, okay? And over on the left of this chart are the values so this is showing if you took $6,000, let's say, who's 25 or close to 25? Anybody here? Okay, so let's say I'm 25, right? And I started putting $6,000 a year. Why are they using $6,000? Because that is the limit you can put into an IRA account, a retirement account, and we'll talk about that later. But if I put $6,000 away into any investment account and my assumed rate is 7%, if I continue to do that, I'll have almost $1.3 million. $6,000 a year, don't stop until I hit 65. That's the assumed rate. Now, there are investments like the amount of mutual funds that are producing higher numbers than the 7%. So naturally, that number would be higher, and you could run calculations on that. Now, if you delayed that by 10 years, you started a little later in life, 35, you'd have about $600,000, okay? Let's take it another 10 years. You're 45, you just got some extra money, and you just started doing this. You'd have about under $300,000, okay? So the point of this is start early and be consistent. That way you don't have to put more money in. So now if this person who's 45 wanted to catch up to the guy who started when he was 25, what does he have to do? He has to put more money in per month, right? He can't do just 6,000. He might have to do 12,000. Try to catch up to the other guy. So that's just to illustrate the power of compounding. And this shows you what I just said. Less is longer, more if you start later. So they go hand in hand. So right here, it's showing the total earnings. So if a guy had put in $10,000, he would end up with $112,000 roughly on the left, right? And that's from the earnings. That's from his growth, the 7%. Now, if a guy had put $30,000, that's what he had to do. He had to put in 3 times the amount to catch up to the guy, almost catch up to him. So that's what this is saying. No, so investments are not guaranteed. They use 7% because let's say it's a good conservative number for them to use on these graphs. But if it depends on each investment, right? We talked about the engines we're putting into these cars. So what do you have, what investment do you have? So I'm going to talk about the Amana Growth Fund, the Amana Income Fund, and we'll look at historical data of how it's done, and that will show you. This is just, I'm just trying to show you some information, general information. Whatever I'm showing or I'm discussing is not guaranteed, okay? Nothing's guaranteed, there's risk involved. So just making that clear. So the other kind of retirement vehicles, I said IRA, right? So now there are two kind of IRAs. Actually, there's more, but we'll talk about these two. Traditional IRA. That's an account that anyone could open, okay, no matter what your income is. If, let's say, your job doesn't offer a 401k and you want to save for retirement, you could open a traditional IRA. You open that account, you can do up to $6,000 a year. You could put money into that account. Now, it says $1,000 catch-up. That if you're over 50, you can do an additional $1,000. So total $7,000 you can put away into an IRA. And so why would you do that? Well, why are we doing an IRA? Well, all of these different accounts, like 401k, IRA, it's all it's a vehicles for the IRS, right? To see how you're investing, where you're investing it. So the IRA will give you tax-free growth, meaning everything that you've earned in there will be growing tax-free. Like you're not going to get a 1099 at the end of the year, right? Or saying that you owe this much in taxes. It's just going to continue to grow. Now, when you do take the money out, you will pay taxes on the growth. So let's say through my lifetime, or let's say through retirement, I put away, I don't know, $50,000. And now at 65, that, alhamdulillah, has grown to $300,000. I'm going to owe taxes, income tax, on the $250,000, not the 50 because that was already taxed, but the growth you're going to pay taxes on. Now, you can't touch this until you're 59 and a half. So you have to wait. The IRS puts these rules in, but now, if you do take it out, some people have taken it out, they get penalized 10% if you take it out less than 59 and a half, when you're under 59 and a half. But the whole idea is to encourage savings and not take the money out. Okay, the other kind of IRA is the Roth IRA. The Roth IRA is money you put away. Again, same thing, same rules as far as, $6,000, the $1,000. Can't take it out before you're 59 and a half. But the cool thing about the IRA, the Roth IRA, is you get taxed on the money when you put it in, but when you take it out, it comes out tax-free. So if I use that same example, I'll pay taxes on the $50,000 that I put in, but the $250,000 that I've earned will come out tax-free. So this is like one of the best vehicles, I think, that especially if you're young, you should look at a Roth IRA. Really consider a Roth IRA. And again, you can do this self-directed with both, which means you could pick the investments and that will make it halal, right? And then 401k for my brother here. I mentioned it, I kind of went through all of this, okay? The other point I didn't mention was, you may have heard of a matching. The company matches, right? That's free money, okay? So if you hear at your company, you start a new job and they say, we match up to 3% of your contributions, that is free money. Meaning if you put 3%, they're gonna put in 3%. So who doesn't want some free money, right? It's the greatest thing. And then the issue with this becomes there's few halal options, right? So what can you do? I get this question at least 10 times a month, right? What do I do? What do I do to invest in a halal way? You can, if it's like Fidelity, Charles Schwab, some of these big names, they have an option called a self-directed brokerage option. So self-directed means that I could pick whatever I want. I don't have to pick whatever my company tells me to pick or those options that they give you, because then you might be getting into bonds. So when you do that, you can purchase, let's say, the Amana funds and make your contributions halal. If for any reason they ask why or they ask questions, you can tell them that, hey, look, I'm trying to invest in the aligned with, I'm trying to do my investments aligned with my values, my religious values, even my ethical values. Because Amana is not just about Sharia compliant, it's also about ethical, it's about the environment, it's about the corporate governance, and we'll get into that as well. But the max you can do is 19,500 into a 401k or 403b. 401k, 403b are one of the same. It just depends where you're working. So if you work at a hospital or you work at a university, chances are it's a 403b. Every other corporate America, any other company that's public will generally offer a 401k. And yes, TSP, yeah, that's a thrift savings plan. It's also another kind of retirement. They give that to government employees mainly, yeah. And then again, it's tax-free growth, like I discussed earlier with the IRAs, similar. And they may have a Roth option within the 401k. And if they do, you should take advantage of that. Okay, simple IRA, this is for businesses, so I'll skip that. SEP IRA for small business owners. If you are a 1099, if you have your own business, there are two types of IRAs you could set up by just simple and SEP IRA. So that's something you could look into if you are a small business, okay? I'm going to kind of skip over this. Healthcare is another important topic, right? Healthcare costs keep going up. It's not getting cheap. So this is just some statistics. A 65-year-old couple who retired in 2020 will need about $300,000 in retirement, not per year, but total throughout their retirement, to cover their health care costs. So this is just some eye-openers that, this is the amount you need, unless you have really good health insurance. Okay, so we're going to get into a little bit about Amana Mutual Fund. So these are 4 funds. First fund that was started was in 1986, the Amana Income Fund. The purpose of that fund was to generate income. How? How can we generate income? We're not doing interest, but what are we doing? Dividends, right. So dividends, so this fund actually includes stocks, right? Like Apple or, all kinds of stocks that pay high dividends. Okay, what's a dividend? Do you know what a dividend is? Anyone know what a dividend is? Okay, let me. So let's say you own Apple. You heard of Apple? Everyone got an iPhone? Okay. So let's say Apple last quarter had an amazing quarter. They sold a bunch of these AirPods, right? And they said, you know what? We're going to reward our shareholders. So if you own Apple stock, you're considered a shareholder, right? So they may announce a 5% dividend. So let's say, for argument's sake, it's $100 a share for Apple, right? To own Apple stock. 5% is $5. So for every share you own, you're going to get a $5 reward, a quarterly dividend, or it could be semi-annually, depends when the company pays it out. So those dividends get reinvested back into your fund. Now, I just said one company. Each of these funds have about 50 companies that generate dividends. So that's why we have that. The second is capital appreciation, long-term growth. You want to, anybody says, oh, what's your best mutual fund? Well, it depends on what you're looking for. But pretty much, I know when people ask me that, they're looking at the one that produces the highest return, right? And so that would be the this Amana Growth Fund, right? Amana Growth Fund has averaged about 17% over the last 10 years, on an average, including the ups and downs and stuff, right? I'll say 2019, it did 32%. It did 32% again in 2020. So just those 2 years alone, whoever was in there, you're able to appreciate a 64% return. Now, this isn't guaranteed. Just happened to be that way, right? Trump was in office. He was doing good for the economy at that time, and not other things, obviously, but facts are facts. But that's what happened, and the market took off. So then the third one was the Developing World Fund. Okay, that came out in 2009. That is our emerging markets fund. Okay, so this includes stocks that are invested in the Middle East and Southeast Asia, that are emerging in their respected countries. And then the last fund that we came out with was the amount of participation fund. We call it the P fund. The whole purpose of that is to give you a fixed income solution. Now, bonds are haram, we said that, right? That's your fixed income. But what does the participation have? That has what they call sukuk. Anyone heard of sukuk? Sukuk instruments? Okay. Sukuks are like halal revenue bonds. They're based on profit and loss. They're not fixed income. They go up and down. That's what makes it Sharia compliant. Those sukuks are issued in, again, the Middle East and Southeast Asia. So the holdings will have these sukuk certificates in it. So that makes it our halal income fund, so to speak. Yes, sir. No, nothing's fixed. Nothing's fixed. So fixed income, when I say fixed income, I'm talking about bonds, but what we did was we had to create something as a solution, right? So it's, and when I say bonds, right, bonds generally give you a low return. They give you 5%, whatever. So the participation fund is not fixed. It's actually based on profit and loss. So those certificates they're like halal. Think of it as a halal bond, but they're not actually fixed. They actually fluctuate. They're traded, so. So that it's very low risk, right? So if I were to, chances are, actually any of the funds, chances are if I put my money and I've been in there long term, your capital is going to be there. To this day in my career, I don't think I've heard of anybody who lost all their money unless they sold when the market was down. So 2008, for instance, the market was down. The people that that had the will and they just wanted to ride it out, if they held on to it, they actually did really well in 2009. But now, if you took the money on 2008, you probably sold it at a loss, right? So at that point, you can't say I was preserving my capital, but had you kept it and it kept going on, and then you would have been in a better position, I would say. So those are the four funds. The objectives. These are objectives on the left-hand side. Okay, some of them are not really literal, but the point of the capital preservation is, and I'll tell you, the goal is to earn between 1% and 3%. That's the portfolio manager. So a lot of our masajid, a lot of our charity organizations will have a lot of money in there because they're not trying to put it at risk. Because this is a very low risk. There's risk, no doubt, there's risk, but it's very low risk. So you may look at a chart that goes like this. You may look at, when you look at this chart, it's like this, like slowly growing up, right? And one thing I try to explain to people, the stock market is like a roller coaster. What does a roller coaster do? It goes up and down, and it scares you, right? So that's really what the point of the stock market is. But at the end of it, you'll end up, you get off the ride, you're happy, same thing. If you stay the course, you'll get off the ride and you'll have accumulated savings. So our funds, Amana mutual funds I just mentioned, are Sharia compliant. You might say, well, you say they're Sharia compliant. Who says you guys are Sharia compliant? So we have a third-party consultant called Amani Advisors, okay? The point that Amani Advisors reviews each of the securities in the fund on a quarterly basis. And they send us a report. And then if everything's good, they send us a certificate, and we upload that certificate on our website to show that it was reviewed by an outside board. We actually have an office in Malaysia. And Malaysia is a big hub for Islamic finance, so Amani is based out of there. And they specialize strictly in Islamic finance. So what are some of the guidelines we follow, right? The left is the obvious. We don't invest into banks. We don't invest into any mortgage companies. We don't invest into alcohol, no gambling, no pork, right? And any other media that's like pornography or something like that, right? The second screen is financials, okay? It's not, this is the obvious, everyone knows that. But what about the financials? There's a Sharia, there's the Sharia board that was formed back in the 80s or 90s, I believe. And they came up with some of these screens, okay? So debt. So the one thing that we and other Islamic or halal investment companies look at is the debt. How much is the company in debt? If it's less than 33%, then it's acceptable, okay? Now you may ask, well, why don't you find companies that have zero debt? Do you think that exists in this country? No, right? I couldn't even tell you on 2 fingers if I point out those companies. Accounts receivable, okay? Do people owe them money? Less than 45%, it's considered healthy company, okay? Now the third point is interesting, haram revenues. I'm gonna say the same thing. Why 5%? Why can't we have 0? Well, if you're trying to invest into any company, they're gonna have interest income. They're gonna have another, so I'm gonna give you a perfectly good example here. Airlines, what's their primary business? How do they make their money? Sell airfare, right? They sell you tickets. That's the primary business. But what else are they doing when you get on the plane? You see John next to you ordering what? Alcohol, right? So brother, it should be haram, right? Like they're selling alcohol. So no, one of the things that we look at is primary business. They're in the business of selling airline tickets. They're promoting alcohol as their main business. We call up their investor relations, or analysts do that, I don't do that. And they ask them, what is the revenue from alcohol sales? They say it was roughly about 0.9%, not even a percent. Okay, it's less than 5%. Then the Sharia, the scholars that have come up with these rules and the consensus have said this is acceptable, okay? Haram revenues, okay? Bed Bath & Beyond is another example. What's wrong with that? They sell pots, they sell the bed, they sell the bath stuff, and then what is it? It's the Beyond. They took over a wine company. The wine company makes up more than 5% of their revenues. So in that case, it wouldn't be acceptable. So just wanted to go over that. I mentioned the chart to you. Yes, sir. Weapons, right. So that's also that's also a screen that we look at. I don't think at least our funds don't have anything that do with weapons, but that's also a big thing. So if you are investing, let's say, outside of our funds, you can actually look for those funds that avoid that. Like when I was at JP Morgan, I used to do that, avoid weapons. You could have those screens. But our funds in particular are mainly technology and healthcare. That's what they're made up of. So weapons, naturally, we wouldn't be Amana wouldn't be doing it, but on your own, even from an ethical standpoint, that's something you could avoid, right? And there's probably a lot of other things that are probably not on here that are social issues and things like that. Right now, we're just kind of covering the basics on this. So Amana versus the S&P 500, right? S&P 500 is the benchmark that we're using in this illustration. And we have our 2 funds, the income and the growth fund, okay? This is just a demonstration. If you took $10,000 and put it away back in 2011, June 30th of 2011, and we looked at, the growth here, 10 years down the line, you woke up. You didn't do anything. You didn't add any money. You just put it away and you forgot about it. You woke up 10 years later. And now the money you had in the Amana Growth Fund is worth about $42,000. Amana Income, about $28,000, okay? So the Growth Fund is the one that, that tends to outperform all of our funds. And then the Income Fund, but you notice the charts are a little less volatile as you go down. And the green one in the middle, SPTR, that's the index. So the Amana Growth Fund actually beat the index without banks, without any other haram companies that we've talked about. Because the S&P 500 will definitely have banks in there. They'll have JP Morgan in there. It'll have Bank of America in there. We don't have any of that, okay? Who was around for 2008? You guys remember 2008? Yeah, you do, right? Most of us do, okay. That's when I first started in the industry. And 2008, what was happening? Do you remember? What was the cause of the markets crashing? Real estate? Over leverage, right? Banks. Banks were the problem. They're giving out money to people who couldn't afford it, right? They all folded, these companies, countrywide, right? That was one of the big culprits that was doing that. So they're giving out money, people couldn't afford it, market crashed. So 2008, and now some people will ask me, well, what about 2008? Well, this doesn't go back because it's not 10 years, but you could look at it on the internet, what our fund did. The Amana Growth Fund was down 29%. Amana Income Fund was down about 22%. The rest of the market was down 40%, 50%, right? The Dow Jones, S&P was down between 40 and 50%. Why were we down 29%? It's because we didn't have any banks in there, and the banks folded, the banks failed, right? I remember Washington Mutual? They gave out everything for free ATM fees, free everything. They got bought out by my company, Chase, JP Morgan, for $1.50 a share, something around that. I've been making that up, but it was around there. So all these companies, they folded around that time. And so the Amana funds didn't have that issue. Yes, it was down. It was still down, but not as much, right? Okay. So you can ask. You could even look at the holdings of the funds that they give you, right? So let's say, a ticker symbol. An example of a ticker is that AMANX, right? So if you were to have one of these funds, AMINX, you could just Google that and then click holdings, and it will give you the holdings of all the companies. So you can do that. I will also recommend there's a app out there called Zoya Financial. You could put equities in there, ticker symbols, and it'll give you all the different standards, IOFI, why it's halal, why it's haram, which scholar says what. So they give you choices. And the founder of that app is a very close friend of mine. He's actually like my little brother. So he's doing very well with that, over 100,000 users. Subscription-based. So if you really want to do like individual investing and you're not really looking at Amana, and the other, I'll give you a little cheat code here, right? If you want to know what we're investing in, we're very transparent. You can go to our website, we'll give you all the listings, and you can sit there and pick the companies you like and just invest in it, because it's already been screened. So the 401, we're running into this issue. We actually create 401k plans, and we work with non-Muslims as well. We don't work just, because actually the Amana Funds isn't just a Muslim fund. It's a lot of non-Muslims like it because of our ethics, our values. Because there are non-Muslims that agree with what we're saying here, right? So believe it or not, 60% of our funds are invested by non-Muslims. So to answer your question, they have to be fair when they create the menu. They can't discriminate, they can't. So when an employer issues a 401k, they're going to give you all the options. And it's your job to really figure out what's in it. And then the easier way, if you don't want to deal with that headache, is open a self-directed brokerage account. I mentioned it to this brother right here, but that's the easiest thing. So Fidelity, Schwab, they tend to have this option. You just ask them. They might ask to pay a fee for it, but it's okay. It's just very minimal. Self-directed brokerage option allows you to choose what you want to invest into, whether it's Amana or whatever else, Azad, any of the other companies that are out there, you can do that. Okay? These are some of the returns. I mean, I'm not, so I mentioned over the last, this gives you like a 1 year, 10 year, and 1, 3, and a 5 year return. This is all on our website as well. You can find this. But this is what the funds have done, right? But I tend not to look at even though they're so strong, the 1 and 3 year returns, I like to have a nicer average. So you always use a 10 year return as a expected return, right? I'll even bring it down. So amount of growth, I told you, from now it's been 17% average over the last 10 years. This is showing 15.48 as of June. Actually, I'm sorry. I think it's as of September. That's what it is. So, oh no, June 30th. Yeah, right on the corner. So as of June, but from now, it's been like around 17%, October. All right. And if you have any questions on how or which funds, on our website, we have a fund selector. The fund selector asks you some basic questions, and it will give you an allocation that works with your risk tolerance, with your time frame, with whatever you feel comfortable with, okay? Yes? Yeah. Yeah. So what an advisor charges as an advisory fee, that depends on that advisor. We're not an advisor, so if you come to me to ask me for help, I'm not going to charge you for my advice. I'm just going to show you these funds, but you see it says expense ratio, right? That's what the fund's internal expenses are, okay? It doesn't, so we're a no-load fund. A no-load means we don't charge you an upfront fee to get into the fund. I mean, when I was at JP Morgan, I was seeing up to like 5%, 6% upfront fees just to get into the fund, okay? And then you had the expense ratios on top of that. So in that sense, I thought it was kind of like a ripoff, right? But with every fund, there's marketing costs, there's legal costs, there's compliance that goes into it. You need to pay the portfolio managers that are creating the funds. So that's how they're paid. It's an internal, it's already priced in, right? So it's not like you're gonna get a bill with a line item that says, oh, you owe us this much money. It's already been priced in. So typically, to answer your question, they charge around 1% advisory fees. I mean, I don't know, it depends who you're working with, right? Yeah, because if you go to a JP Morgan advisor, it might be different. If you go to Wells Fargo. So we don't, like I said, we're not an advisory, so we don't charge an advisory fee. We do have an advisory account. It's called an actively managed account. The minimum is $1 million for that account. And for that, we charge about 0.75 for our fee on that. But these funds don't have advisory fees. But we do offer an account. No. Just what you see here on the, so you notice it says investor share and institutional. If it's over 100,000, you get the lower pricing, which is institutional, okay? Now, if it's an IRA account, automatic institutional. It could be $5,000, you'll still get the institutional. Why? Because you get favorable pricing when it's in a retirement account, that's why. IRA, 401k, whatever. I mean, there's these. Yeah, there's no fees on top of that. No. Not us. Maybe it might have been someone else, but we don't charge that up front. Okay, so I went over Sukuk, so I'm not going to get into that again. But that's it. Invest with caution. Read the fund's perspective. All mutual funds have operating costs. I went over those internal fees, which is the 12B1 fees. Load fund charges are fees that may take a chunk of your investment. We're a no-load fund, so you don't have to worry about that with us. And then each fund has a objective, risk, expenses, advisors, and then you should seek professional advice of a CPA or a financial advisor, planner, before you do anything, okay? Any other last questions, or? We good? Yeah, so I'm gonna stick around here. This is, I have a couple cards I can give you if you're interested. But everything that I discussed pretty much is on our website. You can go to amanafunds.com. My name is Samir. My contact is here. I also have a few business cards. I've been traveling quite a bit throughout Texas doing these, so I'll see how many I have, and then those who are interested can see me after. But yeah, you could also take a picture of this. That's fine. But that's our 800 number, and my extension's there, and then my email address as well. Yeah, we have a brother named Hood Williams. I don't think they put his name up, but if you call our 800 number, you can ask for Hood, H-U-D, Hood. But if you want to get in touch with me, I'm right here, Samir, I'm the second guy. I'm the financial planner for the company, so any financial planning, more in depth, I do that for the company. So you would reach out to me for that. You're welcome. Thanks for coming. I'm sorry? So unfortunately it's internal, but you can take pictures. I can't stop you from doing that. I can't actually email it to somebody because then corporate will find out that I sent an internal document. Yeah, sure, hold on.